Test. Call Imani Anderson on speaker.
Calling Imani Anderson. Mobile.
Hey Imani, it's Reid.
Hi Reid, how are you?
I'm fine. Okay, I've just got somebody, one person on the call that just came up. I was making sure I had the right link.
Oh, okay, I'm about to jump on like through Julianne's Zoom too,
Okay.
so I'll be like
Sure.
in the background if you need anything.
All right, thanks.
Bye.
Hey Kelly.
Hello.
Hang on guys, I'm switching to a different headset. Just a second.
Sorry about that.
No
I
problem.
really
Let me,
not coach you.
switch
So
over this,
welcome, welcome. Thanks for being here, Reid. Oh, I'm in here twice.
Oh yeah, I jumped on as
All right, there we
That's
go.
okay, Lonnie. Totally okay. Oh, that's much better. We are excited to have Reid here today. He is going to be talking to us about all the different kinds of loans that there are and what are the requirements so that you have a really good idea of the differences between them. Not that we're supposed to be subject matter experts, because we're not, but we need to know enough to be not dangerous, but of help to our clients and understanding for ourselves of what's available and optional for them. So Mr. Reid, take it away.
All right, guys, hang with me just a second. I'm moving something over to another screen so I can have it available to share with you guys. Okay. So how's it going? Let's see. I feel like now, Julianne, you might remember this with me back in the day. I think it was it Romper Room, where he had the big window and he'd say, "I see Julianne," and So actually, I do see a few of you guys. I do see Julianne, and I see James. And let's see who else is on here. Chelsea, Regina, Nidra, somebody on their Fire tablet, and Kelly. So I guess we can give it a couple more minutes and get started. So let me do it. Go ahead.
So maybe what we want to do is, what questions does anybody, is there a specific question that you have that we can make sure that we cover today? Anybody have anything pressing? Nope.
Somebody's
Okay.
pretty happy.
That's good.
Okay.
Somebody's
All
very
right. So you guys, you can see my screen, right?
Yep.
And you can see the beagle there. It's actually, look, I have a beagle. Well, it might be a basset hound. I don't know. But anyway, the same type dog. So this is a generic flyer that we have that you can use if you want to give some basic information about loan programs to your client. Can y'all see that okay, or is it a little small? You're muted.
That looks fine.
Yeah,
Okay,
I can
cool.
see it. Of course,
All right.
I'm on a big screen, so.
All right. So the only thing that's changed really, and let me say this, the world changed in the first part of March this year. So prior to, let me back up a little bit, prior to 2008 or so, it was the wild, wild west in regard to mortgage lending. And literally, it's almost true. If you could fog a mirror, you could get a loan. There were some crazy loans out there, 100% financing with a 600 credit score and things like that, just nuts. When the mortgage meltdown happened, all those programs went away real quickly, and we were left with plain vanilla. We were left with FHA, VA, and conventional loans. Jumbo kind of vanished for a little while, but then it came back. But then over the last probably 3 years, we've started seeing some of those programs come back. One of the things that you'll see right here on this flyer, which obviously needs to be updated, is 100% conventional. That doesn't exist anymore right now. There is no 100% conventional financing anymore. A bank statement program. There might be a few lenders who still have resurrected that, but it's going to be hard to find. All the oddball stuff is going to be a little difficult to find.
So help us, just so that we understand, who would somebody be, for those that don't know, would be a good candidates for a bank statement loan?
That would be something like a self-employed person who shows a lot of cash flow for their business, but they don't, but it's wiped out by expenses and they don't show a lot of net income. There, believe it or not, were programs that they would just take the average deposits in a business bank account for 12 or 24 months and make the loan decision based off that, which, yes, you're right, that is a bit risky. But I will say this. There are a lot of paper losses in business tax returns that aren't real losses. And we do take that into account when we're calculating income, but that's what a bank statement program was for. Jumbo loans tightened up a lot. The criteria tightened up in March when the COVID crisis happened, and that has not really rebounded a lot yet. You can still get an 80% a jumbo loan for with 20% down. The difference between a jumbo and a conventional loan is basically the loan size. So if anybody happens to be taking notes, a conventional loan, which you can see right here on the sheet, that the maximum loan amount in our area is $510,400.
How much?
$510,400.
That's the mortgage, not the sales price.
That's right. That's the conforming loan limit. Yes. So anything over that is considered a jumbo loan. Now we do have those, but they require 20% down. We had gotten to the place where you could find some jumbos every once in a while with only 5% down. That doesn't happen anymore. We had it with, we had them with 10% down, but now it's pretty much requiring 20% down on a jumbo loan. I priced one out this morning for somebody, and it looked like the interest rate was about 3.75%, which is still pretty doggone good. It's just not as good as a conventional loan.
So what are the options that somebody has if they're purchasing a home that's going to be more than a mortgage of 510? Is jumbo
Okay.
the only option, or can you do a mortgage in a second?
You can do that. So what Julianne's talking about is what we always called a piggyback scenario, where the client would do the maximum conventional loan of $510,400, and then we would do a second mortgage. And so that would increase the amount they were borrowing, and they could have a smaller down payment. For example, let's say that you had a $700,000 purchase. So I'm going to do a little math for you. Should have probably had this scenario up for you on the screen to start with. So let's do this. So let's say that a client is buying a $700,000 house, and they only want to put down 10%. Well, if you do 700,000 times 0.9, 90%, that leaves them with $630,000 that they need to borrow, right? Well, we know that 510,400 is the maximum conforming loan. So they're going to need a second mortgage of $119,600. Now, right now, we can do second mortgages up to $250,000. In this case, this client doesn't need one. He needs a first mortgage of $510,000, needs a second mortgage of $119,000, and that's going to get him into a $700,000 house with 10% down.
So you said the maximum on a second is $250,000?
Yes, for us. There may be some lenders that do bigger ones. I know that tightened up too, because we could go up to $350,000, and so some of that tightened up. I can get, if it's a real clean borrower, I can get an exception for a little bit higher loan, but in general, that's what it is. Does that make sense, everybody? So what we're trying to do is to back into the number, like the client, we're starting with the number of the client says, I've got $70,000 to put down, which is 10% of the purchase price. And we're trying to help him get the financing package together that's going to allow him to do that. So jumbo interest rates are a little bit higher. They're a little bit higher than conforming rates. Like I said, that one I looked at this morning was 3.75. On a conforming loan or conventional loan, you'd be looking at probably 2.75, which is just crazy.
That's nuts. So what about the second? If you were doing if you chose to go that way versus the jumbo, you've got your initial and then the piggyback, would that also be at that rate, or is it going to be higher as well?
No, a second mortgage has different interest rate and different terms. So you're going to either have a 15-year term or a 20-year term. Before the COVID crisis, we also could do a home equity line of credit. We can't do those anymore. You can get one sometimes at a bank. And just so you'll know, guys, let's say that your client already, they've got a good relationship with their bank, and their buddies down there, and the bank will do a home equity line. You can have us do the first mortgage, and another entity, another lending institution can do the second mortgage. What we have though right now at Silverton is 15-year fixed and a 20-year fixed on the second mortgages. On a scenario like this with good credit, you'd probably be looking at an interest rate at 6.5 or 7. So what I try to do.
Oh, I'm sorry. So I guess for my clarification, and maybe for others that are out there, I always thought that a second mortgage was a Heloc, but it's not. What's the difference between a second mortgage and a Heloc? Okay.
They are technically both second mortgages, right? The home equity line of credit is a different animal. It actually doesn't even fall under the mortgage guidelines like other second mortgages do. It's more of a consumer loan, but it sits in second position behind the first mortgage. Home equity line of credit is different in a few things. First of all, it has the balance on the loan can go up and down. The interest rate is variable. It changes usually based on prime interest rate. For example, Julianne, we might, if you were getting a home equity line, your interest rate might be prime plus 1%. So every time that prime interest rate changes, your interest rate would change, but you're only going to be billed for the interest each month. So it can be an attractive product if you can get it, because like, for example, let's say that you knew that a year from now you were going to sell a piece of property and be able to pay it off. Well, it'd be pretty cool to just pay the interest each month between now and then. But you can also pay it down to zero, and then 2 years from now, you decide you want to put a pool in, and you write the check on the home equity line and run it back up to where the balance was before. So that's where the home equity line of credit is a different thing. It's a line of credit instead of a fixed rate second mortgage that has a set amortization where your interest rate is fixed for the whole term and your payment is fixed, and you're going to just pay that same payment each month until you pay it off. So that's the difference between the home equity line of credit. They are technically both second mortgages. You're right in that regard. They just they act differently.
Thank you for that clarification.
Sure. Let's go. So a conventional loan or a conforming loan is what we would call it. You can do those loans with as little as 3% down payment. That's pretty sweet. Interest rate is a hair higher with 3% down. The PMI is a hair higher with 3% down. But it's a good loan for somebody that doesn't have a whole lot of cash. The basic characteristics of a conventional or conforming loan are you've got to have a little higher credit score. Sometimes you got to have cash in reserves. And your debt to income ratio, right now, it can't go over 49.9%. Just to throw a little more info at you guys to bombard you, debt to income ratio is a really interesting thing to consider. So what I just said a minute ago is that a conventional loan or conforming loan, you can go up to 49.9% of debt to income ratio. Now think about what that means. That means that your client can be paying up to 49.9% of his gross income out each month for his mortgage payment and all his other monthly obligations like car payment, student loans, credit cards, all that stuff. 49.9% of his gross income. If you think about it, most people after taxes, what percentage of their income are they actually bringing home? I don't know, 70 something?
Say 60 to 70, I suppose.
Yeah, you're right, Julianne, because you think about it, not only your taxes and Social Security been taken out, your insurance, your health insurance is being taken out of your paycheck, your 401k contribution. So when you talk about 49.9% of your gross income, that is a big chunk. And we'll get to an FHA loan in a minute. I have done FHA loans where the debt to income ratio was 56%. 56% of their gross income. And you want to try to have a conversation with the client like that and make sure they understand the ramifications that, hey, are you going to be, I'm never going to talk somebody out of financing a house, but I do want to try to engage in a conversation to help them understand that they need to be careful with their finances going forward because there's not a lot of wiggle room.
How about the minimum credit score for a conventional loan?
You can do one. I've seen them price out down into the low 600s, like 620, but that's an ugly critter. So you really, if it's below 680, we're going to look at FHA. But you can get a conventional loan down to about a 640.
Okay.
Yeah. But again, this is where the loan officer starts to do a little determination in as to what loan's better for the client and show them the options, because if they've got a 660 credit score on a conventional loan, unless they're going to put 20% down, it might be better to do an FHA loan. And the reason for that is the interest rate on FHA loans right now is ridiculous. If I've got a client with a 640 credit score, same with VA. I priced out a VA loan last week, 30-year fixed at 2.25%. I mean, it's crazy. And FHA interest rates are about the same if the credit score is 640 or higher. So really, we're going to look at the scenario and determine if it's better for FHA or conventional. A lot of times the credit score has something to do with that. It's a big factor in that. And debt to income ratio does too. I mean, sometimes.
So while we look at conventional as actually the like cash conventional FHA, as far as from a listing perspective is more preferred, from a buyer's perspective, FHA right now is probably better than conventional because they can get better rates. Is that what I hear you saying?
It could be, and this is a great question, y'all. I didn't feed these questions to Julianne first, but that's a good one. Let me tell you why. This is a lot of information. So, an FHA loan. Here's one of the downsides to an FHA loan. The PMI is permanent. It doesn't go away like it does on a conventional loan. On a conventional loan, when the loan gets paid down to where the client owes 80% or less of the value of the house, the PMI goes away. On an FHA loan, it doesn't ever go away unless they put down 10%. Now you think about this. You could have a client, let's say with a 660 credit score, and he has 10% to put down. With a 10% down payment, your first thought is, oh, conventional. Not necessarily, because his interest rate on the FHA loan is going to be in the low twos. The PMI, we know exactly what that's going to be, and it's not going to be that bad because it's the same for all FHA loans. And the PMI will go away after 11 years. So his savings at that interest rate of 2.25% may actually make the FHA a better loan for them. And what Julianne is saying, that from a seller perspective, when you get a conventional offer, you think this is a stronger borrower. That might not always be the case in the current environment because the interest rates on FHA loans are so low. So that would be a situation where the listing agent might want to call the loan officer and say, hey, do you mind if I ask you a few questions? Now, there's going to be a limit as to what all the loan officer can tell you, but you might be able to get enough information. And the loan officer wants to help the deal work, right? The loan officer wants the deal to work. So he's going to try to give you some information to let you know, hey, this guy is actually a strong borrower. It's just that the FHA loan is better for him. Now, some of you guys, if you're working with buyers, or it doesn't matter, or sellers, another factor on an FHA loan that makes them sometimes a little less desirable is that the appraisal on an FHA loan is based on the condition of the house more than a conforming loan is. An FHA appraiser is going to look for things that a conventional appraiser might not. Peeling paint, although if there's enough peeling paint, any appraiser is going to see it. A cracked window, torn flooring, siding that might have a hole in it, rotted wood. An FHA appraiser is probably going to require that those things be fixed before the client closes on the loan. So that's why Julianne was saying, as a listing agent, if you've got a conventional offer and an FHA offer, and maybe the house needs a little bit of work, you might lean toward the conventional offer. But if the house is in good shape, really not an issue. I'm gonna pause right there. And just, does anybody have any questions?
It's really good to,
Sorry.
go ahead, Imani.
Kathleen had a question. She said, what's the minimum credit score needed for a conventional loan?
Yeah, we covered that.
Yeah, that's pretty much, you're going to need to be over 640. But even at that score, that may not be the best loan for you with that credit score.
Okay, thanks.
FHA loans, we can go down to a 600. VA loans, we can go down to a 600. Now, the interest rate is not going to be 2.25% if you have a 600 credit score. It's going to be 4.25. But what you'll find is there's very few lenders that will actually go down to a 600 credit score right now. I don't know, Julianne, what have you heard on that? Do you know?
I haven't heard of any below 600. I mean,
Are most
they were
folks
before COVID, but once COVID hit.
Yeah. Are most folks at 640 and up? I know that Chase at one point was at 700.
I don't know about the big boxes. I stay away from them because it's harder to get deals done through a big box. So I stick with our Supreme and Silverton guys because they get us the job done. So that's really good information for you to share with us about the FHA and conventional, because it's not that FHA is bad. I mean, in some instances, it's even better. It really just depends on what makes most sense for the buyer.
Yeah. And I would, Julian, when I'm doing the screen share, can you see me or are you just seeing my screen that I'm sharing?
We can see you.
Okay. Sorry. I think this is also an important thing to, when you guys are choosing a loan officer and communicating with your loan officer to, well, first of all, obviously choose somebody that you trust, but also tee it up, tee the transaction up, tee the offer up. Because you might say, you know, James, you might say, hey, Reid, look, we're writing an offer up. I'm going to send you the contact information for the listing agent. Would you mind giving them a call and kind of give them the scoop about the strength of our buyer? And I'll always do that. And there's times when that really makes a big difference to be able to go to call and vouch and get that, let them know how strong your client is as they're considering the offers.
It totally does. Communication from the lender means everything from a listing agent perspective.
Yeah, I think so. So let's go over to FHA loans. Federal Housing Administration, they started this program back in the 30s to promote home ownership. It's really taken on a life of its own. Big factor in the mortgage industry and in the real estate industry today. Lower credit scores. We can go down to that one's actually, I guess we need to modify this flyer, don't we? That says 580. We'll go down to a 600. The down payment on an FHA loan is at least 3.5%. Like I said, it's easier to qualify for an FHA loan. You can have a higher debt to income ratio, a lower credit score, those type things. And you know, it's an easier loan to qualify for. Then you've got your VA loans. Obviously that is for a qualified veteran. That's the one I was telling you about a minute ago. 100% financing, rates right now with good credit in the low 2s. Which is unbelievable. 100% financing, no monthly PMI. You know, it's like I said, a qualified veteran. As soon as that client calls us, the first thing we're going to do is log into the VA portal, lender portal, and pull their certificate of eligibility to make sure that their certificate of eligibility is available. And then we're going to price out the loan and go with it. It's the best loan out there, in my opinion. Love doing those. It's a great loan. If I could qualify for one, I would get one.
And so as an agent, one question we need to ask is, do you have your CO, right?
You could, or you could, hey, has your lender pulled your certificate of eligibility? Yeah.
Or
Do you have a copy?
CE, right.
Yeah, COE. And then your, you know, if you've got a client that's going to go for a VA loan, you know, you might ask them, do they have a copy of their DD 214 handy? Because we're going to need a copy of it. And if we have to track it down, sometimes that's a little tricky. We can help them get a copy of it, but sometimes that's a little bit more difficult. But most veterans will have that. The cool thing about a VA loan is the way those loans work. If you structured a transaction where the seller was going to pay most of the closing costs or all the closing costs, I had one that closed 3 weeks ago or so. And he had an interest rate of 2.625%. And he had given $3,000 of earnest money. And at the closing table, he got a check back, an overage check for like $2,700. He got almost all his money back at the closing table. He truly had gone into the transaction with the cost of the appraisal, the cost of the inspection, and about $300 or $400. That's the only loan that you can do that with.
So there are specific, in a VA loan, there are specific things that cannot be paid for by the buyer.
Yeah, it's an archaic list that VA came up with years ago, and they really need to revisit it. It doesn't, I mean, if you read that guideline, it doesn't even make any sense. It has a list. These are the closing costs that the veteran cannot pay. And it's like, it's goofy stuff. It's stuff that's part of every mortgage transaction. The list doesn't make sense. the way Silverton views it is that we are covering that for the buyer out of our $12.95 flat fee. And actually right now we're not even charging our VA loans right now have no lender fees on them whatsoever. But all you do is if the seller's paying some closing costs, that offsets the costs that the veteran can't pay.
So this is an important point for everybody. If you got somebody that's got a VA loan, you definitely want to put some closing costs in there to cover that portion of it. And what does that end up running? You said about $1,300?
Yeah, it's not much. It's not much, Julianne. Yeah. So yeah,
so even if you did 1,500, you should be fine.
Right.
Okay.
Yeah. And like I said, I mean, it is just it's a great loan. I've got one right now. I just got the clear to close on it a minute ago. And I don't know how this happened, but I don't think it took but about 3 weeks. And because right now, everything in the mortgage industry, I don't know if you guys, if you're engaged at all with your lenders and talking, it is I don't even know how to explain to you how busy it is. Are you hearing the same thing, Julianne?
Oh, yes. And so thank you so much for in your very busy season doing this today. We really
Oh,
appreciate
no,
it.
it's a privilege to talk with y'all. The ability to pull off short closings right now is just extremely limited. So, don't write a short contract and then dump it on your lender and say, here, fix it. Make sure you talk to them first and they can do that. We can still get loans done in 30 days. We're just asking, please try not to write contracts shorter than that right now. But it's amazingly busy. Let's see, USDA loans. You probably won't run into that too much. I probably do 1 or 2 of these a year. There's some areas out in Paulding County, Douglas County. It's rural areas, and USDA loans are a little bit tricky. You really have got to be careful with those loans. On your pre-approval, if you've got a client that's doing a USDA loan out in a rural area, you want to ask the loan officer, have they run, it's called GUS, G-U-S. That's the USDA automated underwriting system. And sometimes there are loans that look like they ought to work that GUS doesn't like, and they don't work. So you want to make sure your loan officer is being being very careful on that tricky loan, and that you trust them. It's the loan officer you trust. Let's see. Let's see what we got over here. Conventional loans, jumbo loans, 100% financing doesn't exist anymore. USDA, FHA.
Are there any other requirements for USDA other than it be in a rural area? Can anybody qualify for it?
It does have income limits. It has income limits. It has the debt to income ratios are lower than FHA. It's a little harder to qualify for a USDA loan. Yes. And then we have construction to perm loans, which would be your client that either is buying a house that needs renovation. We can do that loan for them. They can buy the house and roll the renovation costs into the loan with it and do a one-time close. Or if the client has land or is buying land and is going to build a house, we can help with that also.
So how does that work? I mean, without going into super details, how would that construction permanent loan work from our end? And what kind of exhibit do we put?
Now, let's see. I've got one. I should probably have pulled that up for you. Let's see right here. Let me look at his contract. This is an agent that used to be in the Keller Williams office. Let's see what this looks like. We'll see if she did it right. How about that? Ignore that logo at the top left.
Mm-hmm.
Let's see what she's got in here. Oop. So for exhibit, she's got a conventional loan, a legal description, a survey of property, and then special steps. So see, in this what she's done here is Well, this is a little different scenario. This is where the client is buying a lot
Right.
and we're doing the financing for them. That's why there's no exhibits in this one.
Mm-hmm.
If you've got a client who is buying a house and I don't know, Julian, is there a construction exhibit? Or we both stumped on that?
No, I think there is for
This is the
land.
last time Juliana asked me to do this with her because I just asked
No.
a bad question.
So I believe that there's a purchase and sale for land that's separate. It's a separate GAR form for
I
purchase
was trying to
and sale.
see if I've got the contract for the guy. I did one earlier this year for the guy who was buying a house and doing about $500,000 worth of renovations on it. It was a big one. You see what he had.
And how do you figure that in? I mean, how do you even start with that? You find a house that they want. It kind of overwhelms me thinking about it. What do we need to know in that kind of scenario?
So let's say that the client's buying a house that needs a lot of work.
Mm-hmm.
So I think, first of all, most of the time your seller's going to know that the house they're selling is going to need some work, right? And so I think you have that candid conversation with the listing agent saying, hey, you know that my client's getting a renovation loan. Now, what I do is obviously the contract's going to be written up for the purchase price of the house. What I suggest is a special stip that says, or an amendment, either way, all parties agree that the buyer is using renovation funding for the purchase and renovation of this house.
Mm-hmm.
Therefore, the house must appraise for X in order for the financing contingency to be met. So because your client, he doesn't want that house to appraise for just the purchase price. He needs it to appraise for the purchase price plus the cost of the renovations, right? Because that's the amount of money he's trying to borrow. So let's say that he's buying a house for $400,000 and it needs $200,000 of renovation. So a special stip that says all parties agree that the house must appraise for at least $600,000 or the terms of the financing contingency are not met.
So how in the world do you appraise a house that hasn't been updated yet?
Exactly. So your client is going to immediately, right off the bat, he's going to go and he's going to get a contractor that he trusts. He's going to sit down with him and draw up the scope of what they want to do. And he's going to get the list. He's going to get the estimate from the contractor and the plan. What is it he's going to do? If it's an addition, then we actually need the blueprints, right? Plans and specs. And we're going to give that to the appraiser. We're going to say, hey, go appraise this property and tell us what it's going to be worth after these improvements are done. And that's the number, hopefully, that we're going to base the loan off of. It's either going to be, it's the lower of the purchase cost plus renovations or the after improved value. Like, for example, let's say you're going to spend $600,000, but the house is only going to be worth $570 once it's done. Then that's the number we're going to loan off of. Does that make sense? And so you would close the loan at closing. We would close the loan and we would disburse the money to pay the seller to buy the house. And then we would disburse the money for the improvements to the house as the work is done. We'd have an inspector go out every time the contractor wants a draw to look at the work that's been done. They'd say, yep, it's progressing just like it ought to. You can safely advance more money.
And this would be true whether you were doing renovation or a complete tear down and building something new?
Yep. The same thing. It's almost the same process. It is the same process as if you were buying a lot and building a house. It's a little bit different if you're already on the lot because, we're just closing the loan and starting immediately to disburse construction draws. Now, what happens on that is it's really a great loan. During the construction phase, the only thing the client is going to be responsible for is the interest that accrues each month. So let's say it's going to take him 6 months to do all the renovations on this house. And we disbursed $400,000 at closing to buy the house. He's going to be billed interest on that $400,000 plus however much he spent for renovations month by month by month. And then when you get to within 45 days of closing, he contacts us. We verify that he's almost through, and he says, I'm ready to modify my loan into my permanent financing. And at that point, we do a loan modification agreement that says, you know, instead of an interest-only construction phase, it clicks into his 30-year fixed phase, and he starts making his payments every month and lives happily ever after. But there's only one closing.
So there's only one closing.
Yep. The modification is doesn't even have to be done at the attorney's office.
Huh.
All it is it's a modification of the security deed that we recorded when he bought the house. And then it just modifies the terms of the loan.
But the sellers got their money.
Seller's gone. He don't care.
And the title goes to the buyer.
Yep. Yep.
So question then, if they're paying interest only, but then they're modifying it, when they modify it, if interest rates have gone up, is it at that new rate or is it the original rate?
No, it's at the original rate. Like right now on a construction to perm loan, I looked at it last week. The interest rate was, I think it was 3.25 with no origination fee. So what that means is the interest is going to accrue at 3.25% all through the construction phase. And then when he modifies, it can't be higher than that. He gets to float it down to whatever the current market is. So maybe he floats down to 2.75, but he's also protected because if rates go up, he's not going to be higher than 3.25.
Cool.
Yeah, it's a good deal. You know, it's always a pain in the rear to get your contractor lined up and to walk through a project like that. But the loan itself is actually a really good loan. And that's what I'm going to be doing this afternoon is working on one of those.
How is that different from a,
The old renovation loans we used to do?
Yeah, like what is it?
203K, the 203K or the home style renovation.
Yeah.
I don't know, Julianne, if other lenders, we're not doing any 203Ks right now. And we're not doing any home style renovations because this product that we have is actually better than either one of those. It's better than either one of those. It doesn't have the broad criteria like a FHA 203K because the 203K, you could still put 3.5% down and ours requires at least 5% down.
So for those companies that do offer something like that, but they're limited by the kind of upgrades that can be done, right? Usually it's carpet, paint. It's not major. It's not moving walls or anything like that, right?
There's two different types of 203K loan. There's the Streamline 203K, which will do up to $35,000 of renovations. Mm-hmm. And then there's the full 203K, which can go up to the FHA loan limit, which is like 401,350. That one, that's the one that's for big renovations. And that would be for a client that has a 650 credit score. He can't qualify for our renovation loan. But he needs to do a renovation project on his house. We don't have that right now. And they have tightened up. I think lots of lenders have pulled back on that. There's probably somebody that still doesn't. Okay. Seems to always be somebody still out there.
How is it that different lenders can offer different products? The amount of risk that they're willing to make?
That's the big thing. If it's a bank, in one sense, they can almost do anything they want to do because they can have a portfolio product that they're never going to sell on the secondary market. They can say, I'm First National Bank of Reid, and I think that loans with 0% down are no risk at all. I have no problem with them, so I'll do them. That's not going to last very long. But you've also got loan companies that they have to be able to sell those loans. And so they're going to be limited as to what the big investors will actually buy. And that's where that comes from. Now, we've got a little bit different scenario because our parent company has got really, really, really deep pockets. And so when the COVID thing happened and everybody else wouldn't do FHA loans, for example, that were less than 640, Our parent company said, we'll do those. We'll service them ourselves. We're just not going to sell those to anybody else. And so that's how we're doing those type loans. And then we've also got a portfolio product. We call it our Just Missed program. And that's for the guy that I did one a couple of months ago for a guy that great credit, putting 30% down, had been a physical therapist for years. And all of a sudden he changed from living down in McDonough and working for a company to becoming a part owner in a chain of physical therapy offices up here in our area. And you look at the scenario, he's putting 30% down. He's got great credit. He's got great housing history. He's got a contract that tells him what he's going to be paid. It didn't meet conforming guidelines, but we did the loan for him. So, it's kind of a make sense loan committee type loan, where you can do a loan that makes sense, but maybe doesn't meet guidelines, FHA or conventional.
So that does lead us to a question, and that is the difference between a lender and a broker.
Yeah. When I first came in the business, my first 2 companies I worked for probably the first 3, 4 years I was in, were both brokers. So a broker, what they do is, the client comes in, they get all the client's information, and then they turn and look, and they have 10 different lenders that they can send that loan to. And the truth of the matter is, there's going to be 2 criteria that they determine who to send that loan to. Number 1 is, who will do this loan? Number 2, which one of them will pay me the most for it? And then they just stack the information and send it to them, and they wait to see what happens. They don't have any control over it. They don't have control over closing. They don't have control over funding. They don't have control over underwriting. A lender actually has all those functions in-house. A lender is going to do the underwriting themselves. They're going to fund the loan with their own money. Everything is right in-house. They have control over the file, usually can get things done in a very expeditious way, and have more autonomy over making decisions. So I think the lender is the best of both worlds. And then you've got banks on the other end. Banks are fine, except for the fact that they're so big and cumbersome that sometimes it's dumb what banks do. I mean, they can't get out of their own way. And you need an answer from somebody, and you can't get the answer. And something that ought to take 3 days takes 3 weeks, and you don't know who has it and who to even talk to. And then at closing, you're waiting on closing funding authorization, and there's crickets on the other side. I mean, there's no need for a client to go to a bank. I'll just be honest with you. I mean, God bless them. They do many things well, but your client's going to get a much better service if they're going to use a good lender. That's my opinion. And I do have some skin in the game. So what else?
All right. How about down payment assistance? Are there any out there right now, and what does that look like?
Yeah, down payment assistance. There are some, I think, programs still down inside the perimeter, Invest Atlanta and things like that. I don't do a lot of those, and the reason is because I've never had clients. I mean, once a year I might have somebody even inquire about it. Now, the one that we will use the most would be Georgia Dream. And we're happy to do Georgia Dream loans. Georgia Dream provides down payment assistance to a qualified buyer to assist with a down payment or closing costs for a house. It does have income limits. Those limits are about $82,000 for a family of 3 or more, I believe is what it is in our area. There are credit score limits and debt to income ratio limits, but we know all those, and we're going to really screen that person, before we give that pre-approval letter. The thing about Georgia Dream is there's 4 basic Georgia Dream programs. The basic Georgia Dream program gives $5,000 of down payment assistance. The problem is, excuse me, the problem is that the closing costs are higher on those loans. So sometimes the higher closing cost eats up a good bit of that $5,000, and it doesn't really make sense to do that. There's 2 programs that give $7,500 of down payment assistance. One of them is it's called the PINS program, Protectors, Educators, and Nurses. So it's anybody who works in a school system works in a medical facility, doctor's office, hospital, anything like that, or a fireman or police officer, protector. Those that get $7,500 down payment assistance, that loan can make sense. And we've gotten many police officers into a home using that program. There's also one for someone who has a handicapped person that's living in the house. That's called the Choice Program. And that one has a $7,500 down payment assistance. And that one would probably make sense. The other one, I hesitate to even mention it because it's going away at the end of the month, was the HHF program, the Hardest Hit Fund. That one was a great program, $15,000 of down payment assistance. But the list of counties where it was eligible for getting smaller and smaller, and now that program's going away at the end of August. So you won't see anybody using that anymore unless they extend it again, which I wish they would, because that's a great program. And that loan, that $15,000 actually is a grant that goes away after 5 years. Don't have to pay it back. So that's the main down payment assistance, Julianne, that we would be, you'll see most people utilizing.
So they haven't gone away. They're just limited on what's available out there right now.
Yeah, and there have been different, I mean, I've been doing this 15 years, and there have been different ones that came up and lasted for a year or two, and then they went away. But Georgia Dream has been a pretty steady performer, and it's an FHA loan,
Right.
And they set the interest rates for it. And I think the interest rate for that loan now is about 3%. So it's a little higher than where we are on a regular FHA loan. And a lot of times when we'll talk to a client about a Georgia Dream loan and we start doing a little digging and we show them the benefit of doing a non-FHA, a non-Georgia Dream loan, a lot of times they realize, hey, you know what? I've got a relative that can give me a gift, and maybe a regular FHA loan is better for them. And
I also want to remind everybody that in FMLS, I can't remember if it's on Georgia MLS, but I know for sure it's on FMLS. Each listing, if it qualifies for a certain down payment assistance based on location, there will be an insignia that says DPA or DPS on that listing. And if you click on that button, it will show you the different options that are available in that listing for that particular listing.
Yep.
So it may not be per person, but there are programs per area. They're limited now more than they were before COVID, but there are available.
And guys, you never know. I mean, Julianne, remember the HUD $100 down? Mm-hmm. That was after the crash in 2008 when FHA had to foreclose on so many thousands and thousands of houses. And they were having to enter into contracts there was 3 entities that would manage their foreclosures for. PIMCO was one. I don't remember what the other ones were. But and so a client could buy a HUD foreclosure with $100 down payment. Yep. And so, different times you'll see things come and go like that, just whatever's happening in the market.
What do you anticipate happening? I'm hearing a lot of scuttlebutt that towards the fall that things are going to go to hell in a handbasket and we're going to have all these foreclosures. And if that happens, how will that affect mortgages? I think it's going to be interesting to see. And I'll be honest with you, Julianne, I try not to think too much about it because it can get scary if you really think about it, because I think that there are a lot of people right now who are keeping their head above water because of the $600 a week or whatever the next version of the unemployment benefit is going to be. I mean, you see what's happening in the Congress right now. I think one side wanted to do what they found out was they did some surveys. They found out that at $600 a week, there were a lot of people that didn't want to go back to work because they were making more money sitting at home. Fancy that. Most people that I've talked to, almost every single person was making more in unemployment than they were when they were working. And
I want people to be blessed. I want them to have enough money, no question. Mm-hmm. But I think, it's just human nature. If I can make more money sitting at the house, what am I going to do? So one party wanted to do $400 a week to try to give some incentive for people to go back to work. But regardless, the other thing was that employer, the loans that was made to the employers that they had to use for payroll, payroll protection plan, I think PPP.
Yep.
Well, part of them taking the rules for them to take that money was that they couldn't lay anybody off. They had to keep people employed for a certain length of time. Well, if I'm not mistaken, that length of time ends in September. So the question is, if the money's run out and they don't have to keep these people on their payroll, are there going to be a lot of people unemployed? And what's going to happen as we go into September and October? And that's one of the pressures to try to open the economy back up to get people back to work. It's a tough time right now. I mean, right now you've had a moratorium on evictions from rental properties, and you've had a moratorium on foreclosures. So, and I think that moratorium on foreclosures goes to the end of the year. So what's going to happen next year? Are we going to see foreclosures start to go up? And I hate to see that. I know it makes a great opportunity for people that want to buy rental houses, but I would rather that didn't exist. I would rather people be able to keep their houses. It just causes a lot of problems, and it's a lot of, it's just really sad when you think about somebody that they've worked so hard to buy a house and then lose it. You don't want to see that happen.
Exactly. All right, everybody else. I've asked lots and lots of questions here. Who else out there has a question regarding loans or mortgages for Reid? Now is your time to ask.
I have one question. Reid, I know Silverton is not the one who does this, but I have several people who have, cash. They just have tax ID, but they are asking me, like they can put even 30% down for a house. And the thing is, I can't find lenders that work with them. What do you suggest there?
Yeah, that was one of the programs, kind of like the bank statement program, excuse me, they got really, really scarce. There were only a handful of lenders, Marlon, that did, as you know, that did tax ID loans before COVID, right? And now I don't know. I don't know of any. You don't want to send somebody like that to a hard money lender. A hard money lender is probably going to want more than 30% down anyway. It's a very difficult time, and it's very hard to find a loan for somebody like that. I don't know who is doing tax ID loans right now. And for everybody else, that's a person that doesn't have a social security number.
Yeah. Okay. And my next question, I'm sorry, and maybe you mentioned it before, I just got a little late. So I have another client who is, there is a lot next to her house. She bought the house and a lot, but can she get a loan for a piece of land, even though she is not planning to build anything there now?
Does it adjoin her property?
Yes.
Well, what she might want to do in a case like that is do a cash out refinance on her current house if she has some equity in it.
Mm-hmm.
And then she can either, if she's got enough equity, she can just buy it, which that would be preferable. Or she could do a cash out refinance and actually roll those two parcels together into a new loan. But if she could just take the cash out based on her current property and then just buy the lot, that would be better for her, because that way that other lot is free. It doesn't have a loan on it. If she wanted to sell it in the future, she could.
Oh, okay. So
Oh, you muted yourself.
Oh, does she have to talk to a lender about it, or how can she understand this?
Yeah. If she needs financing to buy that, yes.
Okay. I will tell her then. Thank you.
Yeah. It depends on, when did she buy her house? How much equity does she have in it?
Yeah, she just bought it 1.5 years ago.
How much did she put down?
30%. 30%.
Like,
the house was 150, that house with a lot, and she put maybe a little bit more, like 50,000.
She probably has some options to be able to do that.
Okay, I will tell her.
Okay.
And one more thing, talking about foreclosures, Julian. So I don't know if we are planning to have classes about foreclosure soon, because I know it's a scary time and we don't want to think about it, but I have seen more and more advertising coming to my email, talking about learning about foreclosures and opportunities for foreclosure. So I don't know if it is something that,
It's already in our plan to start talking about it.
Thank you, Julia.
Mhm.
We wish we didn't have to.
Right, I agree. But it is what it is, right? So
Yeah.
We need to prepare for the worst and know what to do in that case. So yeah, for sure.
Yeah. Anybody
Yeah.
else?
For those of you that are in our ramp up class, we're going to be having Courtney Newton come in and talking to us about REOs and BPOs. So we'll start there and then we'll open it up to everybody else later on. Okay.
yeah, I have one more question. If I just was quiet, giving the chance to somebody else, but sorry, I was really interested in this class. About appraisals. So when you get an appraisal and it's lower, I was representing the buyer. And is there a way that you can refute that appraisal as the seller, or it has to be the buyer?
No, you want that to be driven. Like, for example, in your case, it needs to be driven by the listing agent. I mean, if I'm representing the buyer, my inclination is I want to get them to reduce the sales price.
Right.
Now, if I have to get pulled, like if the deal's going to fall apart and my client really wants it, at that point, as a buyer's agent, I would probably engage with the listing agent to try to pull together information for a rebuttal. But I think I've really been surprised, Marlon. Honestly, I've been surprised when an appraisal comes in low and a buyer's agent immediately starts going berserk, and usually at the lender, like I had anything to do with it. And I'm thinking, wouldn't the best first reaction to be to see if you could use this as a leverage to get the price lower for your client? I mean, to me, that would be the first thing you'd want to do. Like, man, maybe my client's going to get to buy this house $10,000 cheaper. Now, you may find out quickly that the seller's not willing to do it. And at that point, you and the listing agent are going to engage and try to work a plan. But yes, if there are better comps than the ones that the appraiser used, or if there's something that's wrong in the appraisal, if there's data that's erroneous, what we would have asked the agents to do is send that to us in a good format with your comments and PDFs of the listings and that sort of thing, and let us send it to the appraiser and see what we can get. I had one with Chris Van Zant 3 or 4 weeks ago that came in, seemed like it was $35,000 low.
Mm-hmm.
And we sent some info up. We sent the info back to the appraiser and worked with him, and he brought it up to, it was only, I think it ended up being $15,000 or $10,000 low. Now the listing agent didn't like it a bit.
Well, the point of that though is that it has to be new information. It can't be the same comps that they used, right?
Right, unless he made a mistake. Yeah, unless he calculated something wrong, or the square footage was wrong or something. Yeah, it's got to be new comps or different comps. Like, hey, why didn't he use this comp? It's closer. It's the same size. It's sold right across the street. Or I have had one before, Marlon, where, the day after the appraisal was done, another comp closed that would have gotten the value up. And at that case like that, we're gonna revisit that and try to help the appraiser get that included.
Yeah, well, in my case, it was that two things happened. So they took the comps that they took, it was in the last 5 months in the area, and it was COVID. I mean, there were really not much to see. So they really, they were, from my point of view, they were far away from the comparable, the subject house. And it's not that I didn't want the lower the price for my client. Of course, that was better. But the seller refused to sell the house and reduce the price. And with my clients, I was trying to get a house for them for the longest time. And we were losing because they wanted Cumming or Alpharetta. And we were losing every house that we put an offer. So this was the house number 7. And we finally got under contract. So they were really torn apart, thinking that they had to terminate because there was, the price we were going to pay was, the offer was $280. and the appraisal came to 62. And as I said, the seller refused to go down, but so we terminated.
Well, see, in that case, Marlon, that case, the first thing you did was you sent over an amendment to reduce sales price, and you found out they're not going to do it.
Right.
Then you probably said to the listing agent, hey, can you provide some info to refute the appraisal? And if the listing agent says no, in your case, then you had to do it.
Yeah. Oh, okay.
And that perfectly makes sense. I mean, I totally get it. You're trying to keep the deal together.
Right. It's just the last step I missed that I could provide that information. I honestly, when maybe lack of experience, I didn't do it. And the listing agent was Duffy, and they are not very helpful.
Oh, no.
So, yeah.
You don't get a lot of help from them on that.
Yeah. Okay. Thank you.
Thank you.
So, and I know we're a little over on time, but to that point, so I had a deal where it did appraise just under, and we were able to come up with a variance where the buyer paid some or came cash to close, and the seller came down a little bit on the sale price. So we came kind of to a middle. But the lender was able to work something out where the buyer didn't actually have to bring that amount. It was reduced. So was that through points, or how did they do that? I didn't ever understand how that could happen.
Well, you can do it a couple of ways. Let's say, for example, the client was planning to put 10% down. Then they just put down 7%. They're down. That's probably what it was.
Oh,
that's a good one. Yeah, you're just kind of shifting the money from down payment to paying the difference between the appraisal and the purchase price. That's the one with Chris. That's all. I think that's exactly what we did. I don't think they brought any more money to closing.
That's a good point for us to remember, is we need to make sure our lender knows so that we can work with them to try to figure something out too.
Yeah, and it's tough. It's tough if they're only putting 5% down, because there's just not a whole lot. They're going to pretty much have to come up with additional cash. But if they're putting down more, then you've got something to work with. You can make it happen with the same pot of money.
That's a good one. Thank you.
You're welcome.
Awesome. Well, thank you, Marlon, for your questions, and Reid, thank you so much for your time. We appreciate it so much. I know this is your busy season like it is for us, but it's so important for us to understand this better and to really get a good feel for, even though we're not the experts, it's important for us to know what's going on behind the scenes. So
absolutely.
Thank you. This has been recorded, and you can always refer back to this at our quantrain.com, which is our private YouTube channel. So Reid, we appreciate it. So Reid and I are going to do a homebuyer seminar coming up. I don't know if it's next week or the week after, but we've got one.
I was looking at my calendar. I saw that. I think it's next week, isn't it?
I think so. Maybe next Wednesday.
Like that.
Anyway, thanks everybody for being here. We appreciate it, and we'll see you soon.
All right, guys. Thank you.
Thanks.
Thank you. Bye.